A very good morning to our MIIM members and friends in Germany, and good afternoon to our participants joining from India. Thank you for joining us today for the informative webinar Decoding India's 2024 Union Budget, being organized under the Make in India Mittelstand program in association with our MIIM partners, Khaitan & Co. and Rödl & Partner. Rödl & Partner is the knowledge partner for the MIIM program, and I'm Maya Yadu, the MIIM project coordinator for Rödl & Partner in Pune, India, and I will take you through the session today. Before we continue the session, let me briefly explain the technical side of our program. The following functions are available to you. In the upper right corner of your screen, you will find a control panel. Here, you can adjust the audio settings and choose, for example, between your headset or the computer audio. Please note that as a participant, you are muted by default. A bit further down the dashboard, you will find the question panel. We request the attendees to please post their questions in the question section, and we will take these up in the last leg of the webinar during the Q&A. Now allow me to very briefly introduce the Make in India Mittelstand program. MIIM is an initiative of the Department for Promotion of Industry and Internal Trade, DPIT, and the Embassy of India in Berlin. MIIM provides a platform that integrates a wide range of support services for German Mittelstand companies and family-owned enterprises. It is part of the Make in India initiative of the Indian government and is a program designed to facilitate investment, foster innovation, enhance skill development, protect intellectual property, and build best-in-class manufacturing infrastructure. The MIIM program offers all support services like strategy consulting, M&A, operational market entry support, tax and legal support, financial services, project financing, location services, technology collaboration, and facilitation of approvals from central and state government agencies under one single umbrella. Part of the MIIM program is today's informative webinar, in which our speakers will decode the union budget for you and share their professional opinions on the changes and announcements within the 2024 union budget. Allow me to very briefly introduce today's speakers. Let me start with Sudipta Bhattacharjee. Sudipta is a partner with Khaitan & Co. He's a lawyer with more than 19 years of experience specializing in advisory, investigations, litigations, and contractual disputes under GST and other indirect taxes. Sudipta has been repeatedly recognized as an indirect tax leader for India by the International Tax Review and has recently been recognized as a litigation star for Tax India for 2024 by Benchmark Litigation Asia Pacific Rankings. Next up is Gaurav Makhijani. Gaurav Makhijani, Associate Partner at Rödl & Partner, is a qualified chartered accountant and a postgraduate in business finance from Symbiosis University, Pune. He has 14 years of diverse experience in corporate and international taxation. Gaurav's key areas of expertise include corporate tax strategy and planning, tax due diligence, tax and regulatory aspects of mergers and acquisitions, inbound investment advisory, and structuring cross-border transactions. We also have Khushbu Jain on board today. Khushbu is a qualified chartered accountant and a lawyer by profession with an overall experience of 12 years in indirect taxes. She's working with Rödl & Partner as a principal associate in the field of indirect tax in the Gurgaon office. Khushbu's key areas of expertise include indirect tax advisory, litigation support, as well as supporting clients in custom matters. Next up is Moin Lada. Moin is a partner and leads the regulatory practice at Khaitan & Co. Mumbai. He's a qualified solicitor with over 16 years of experience in public M&A and securities and regulatory practice. He works closely with Indian regulators and advises MNCs, PE funds, and sovereign funds on investments in regulated structures, listed entities, and on complex regulatory issues, including regulation of non-compliances. Now, without further ado, I'll hand over the virtual mic to our first speaker of this session, my colleague Gaurav. Gaurav, over to you.
Thanks, Maya. And good morning to our colleagues joining us from Germany, and good afternoon from our guests joining us from India. Is my screen visible, Maya?
It is.
First, I'll take up the economic overview of the budget. Now, we know that the Indian government has presented its final budget for this year on 23rd of July. So today we'll discuss about various aspects of budget, but first we'll discuss about the main highlights of the budget, on which area government looks to take India towards. Before that, few statistics of the budget of the past year performance and also what government is looking at in future. So as far as the growth is concerned, India has attained the growth of 8.2% in terms of real GDP, and nominal GDP was 9.6% in financial year 23-24. As far as 24-25 is concerned, the expectation is that they'll meet somewhere around 6.7% to 7% of real GDP growth. Here, interesting to see is that industrial sector has grown to 9.5%, whereas the traditional focus area of Indian economy, service sector, has grown to 7.6%. So that also shows that the robust economic overview in terms of manufacturing and industry sector. India has also been great with the consumption side of economy, and if we see private consumption, that has shown the growth of 4% in financial year 23-24. In India, everybody knows that it's looked as a great market for world. As far as GST collection is concerned, we've seen that there was 11.7% growth of over the year-on-year basis, and GST is something which is just Indian VAT, goods and service tax. Now, as far as fiscal consolidation is concerned, this is the main area where government is focusing on. And for 24-25, the fiscal deficit which government has budgeted is at 4.9%. And for year after that, the government has set a target of to achieve 4.5% of fiscal deficit. As far as key priorities of government for next year is concerned, so there are a number of items, but primarily I would like to highlight here is the intent of the government to invest in capital infrastructure, and they've set the target of 3.4% of GDP, which is around 11,000 INR, 11,000 billion INR is the amount of capex which they want to invest in infrastructure sector. Other than that, there are other various items which we'll cover in our later part of session. For example, Provident Fund to boost the employment, and about industrial park which government is trying to build in. Now, coming on to the main part of budget, first I'll take up the direct tax, which is the corporate tax budget updates. Now, as far as the tax rates for companies in India is concerned, there's no change in the domestic tax rate. However, there was a demand from the industry, because if you see the domestic tax rates, the domestic companies are taxed at the effective tax rate of 25%. Whereas if you have a manufacturing, a production company in India, which has started its commercial production before 31st March 2024, then the tax rate were 17% effective tax rate. The demand from the industry was that you extend this deadline of 31st March 2024 further. But this is something which government has not done. So for all the companies which we are now setting up in future manufacturing and start commercial production after 31st March 2024, the tax rate of 25% would apply. Now what government has simultaneously done is, for foreign company, the tax rate was 40%. Now they have reduced it to 35%. One may ask why there is a gap between domestic company tax rate and also the foreign company tax rate. So the answer to that is, if you have a daughter company in India, which is paying tax at the rate of 25%. Now you have some funds in India which the profit is generated by a subsidiary company. If they want to repatriate, remit this fund back to, for example, in our case, Germany, 10% dividend would apply. So this 25 plus 10%, the effective tax rate for earning the money in India and then also transferring it back to a German bank account, the total tax paid in India was 35%, and therefore the government has made parity and brought down the tax rate from 40% existing to 35%. So this is a simple tax rate chart. We already discussed about the effective tax rates. So I think this presentation would be shared with you, and you can have a look at which tax rate would apply to you. There were few amendments which government has introduced on the capital gain side. So the basic general perception, as also in European law, is that if you have a capital assets in India, for example, immovable property, land, building, or you have invested into share of a domestic company in India, and if you transfer that capital asset, because the asset is situated in India, it is subject to capital gain tax in India. So the government has tried to reduce the complexity. There were a lot of rates, a lot of time period where different tax rates were applicable for long-term capital gain and different tax rate were applicable for short-term capital gain. The government has tried to simplify the provision, and they have said that long-term capital gain, which was earlier charged at 10% for some capital asset, at 20% for some capital assets. So they've done away with different rate. They've come out with a simple regime that if there is any long-term capital assets and it is transferred, then the tax rate would be 12.5% only. And there was some indexation benefit because of the inflation adjustment amount. Now, this is something which has been taken away. For non-resident, importantly, if you have a German company who have invested into India, earlier, if you sell the share, your tax rate, if it's a long-term capital gain, so if the holding period is 12 months, then you're subject to tax in India at the rate of 10%. Now, the rate would apply is 12.5%. So there is an increase in tax rate as a non-resident, as far as non-resident is concerned. But interestingly, because of some changes in the law, uh, we are also able to take foreign exchange fluctuation difference. So earlier, when we were applying for 10% rate, the foreign exchange difference rate, we were not able to claim as a benefit. But now with this 12.5%, the foreign exchange effect can be taken away. So the idea is to make things simpler for non-resident. It may even be more beneficial. Even though the rate has been increased from 10% to 12.5%, if I'm excluding the foreign exchange gain which has happened with the economy, my tax rate or the effect would be even lower than what it was with 10%. Similarly, there are some other changes, but it is not very relevant for our investment into India from Germany perspective. So I'm not covering that, but this is something which is already there in our slides. One important point again in the capital gain tax, which I specifically wanted to highlight here, is unlisted debentures and bond. So as far as non-resident is concerned, there is an option that you invest into Indian company by way of equity share, but also you can issue a debenture or bond to your subsidiary company. So there are some changes made in capital gain aspect from this perspective also. Government has said that if you are issuing any debentures and bond, then the tax rate would be always short-term capital gain, and the tax rate which would apply would be on the applicable tax rate. Now, interestingly here, if I look at the income stream from the debentures and bond, I could see that it may be characterized as interest income. And under the India-Germany tax treaty, the rate could be 10%. So this area is still a gray area, not a very clear area. We'll have to do some research and explore if we can take the tax treaty benefit, and even though the rate may be higher, applicable tax rate would be 35%, but we can say that the income which is generated from debentures or bond is an interest income, and therefore the tax treaty would come into picture and we can apply 10%. So this is one benefit which we can explore in as far as capital gain tax changes are concerned. Then there were some mergers and acquisition related changes. One was the so-called angel tax. Now this has been abolished. What it was when we as an Indian domestic company is issuing shares to any person, including non-resident sitting in Germany, a company in Germany. Now, the government said that you have to undertake a fair market valuation. And if a consideration received for issuance of share is more than the fair market value, then the additional amount which you have received should be taxed in the hands of domestic company. Now, there was a lot of challenges and discrepancies in fair market valuation. There were a lot of assumption-based and litigation which was happening. So government has now abolished this law. You do not need to have fair market valuation anymore. As a non-resident, this becomes less complicated and more simplified regime, because I do not need to go into now the discussion of fair market valuation, and litigation to that extent has been reduced and things have been made more simpler as far as issuance or equity infusion in domestic companies concerned. Now, one part which we have to be mindful here is even though the fair market valuation has been abolished, in India there is a law which Section 68 under the Indian Income Tax Act, which says that there would be tax on the unaccounted money. So whenever a non-resident is actually investing in India, there is a requirement that the source and the source of funds is something which, if asked by the tax authorities, to be established. So that's one area which is still open. The tax litigations are happening tax officers are going into this requirement that if you have invested any fund in India, you need to establish from where does this fund come from. So there are different ways of dealing with that. But of course, when looking into investment into India, this aspect needs to be considered. Moving on to the next amendment, there was a buyback tax which was applicable in India for domestic company. Now, there's not much change, but the government has said that if in case of buyback, earlier it was tax something like a capital gain tax, where if domestic company has issued share, now they want to buy back. So it would be considered as a transfer of share, and the tax rate of 20% was applicable. Now, government has changed this regime. They've said that in case of a buyback, if as a domestic company I am purchasing back my share, I'm paying some amount to the shareholder. So whatever amount shareholder has received, this would be subject to tax as a dividend in the hands of shareholder rather than a buyback tax in the hands of domestic company. For non-resident, this may be more beneficial because under the India-Germany tax treaty, the tax rate for dividend is 10%, whereas buyback tax was at the rate of 20%. So as a group, if I see the tax burden as far as non-resident is concerned, is something it can be explored, but the tax rate might come down. On the last box, we have transfer of capital assets under gift and will. This is something wherein if you are transferring any capital assets, it was subject to capital gain tax. But if you are transferring any capital assets under any gift, will, or irrevocable trust, this was something which was not subject to tax in India. Now, intention was that if I'm giving my property to my son, daughter, etc., it's coming out of natural love and affection, and therefore that gift, etc., is something which would not be subject to capital gain tax in India. But corporate was using this as an opportunity because there's no specific exclusion. One corporate wanted to transfer the share to other corporate in a group entity itself. So they were actually making a gift of share from one company to another company. Government said that this would not do. This intention of gifting and will is something which only pertains to individual and HUF. So government has just simply clarified that corporates are outside this exemption, and if they're gifting one company's gift share to another company, this would be subject to tax in India. For non-resident, one very important amendment was on the abolishment of equalization levy. Now, this equalization levy is something which is coming out of base erosion and profit shifting program of OECD. And under the Indian law, it was something which was brought in outside the tax treaty framework, wherein any non-resident, primarily an e-commerce operator, when it supply goods and services to Indian customer, an equalization levy of 2% on gross receipt was payable. Now, the way e-commerce operator was defined was that in case there's an online transaction, even though, I mean, it doesn't matter whether it's on for purchase or sale or even for the payment. If you are using any modern means of communication, you were termed as e-commerce operator, and there was no clarity whether even the manufacturing company who's using electronic platform for payment purposes, whether equalization levy would apply or not. There were a lot of representation made to introduce more clarity, but government has finally done away with the entire law itself. From 1st August 2024, this law is no more applicable. Then there's something which has been introduced for cruise ship operator. If you're a cruise ship operator and you're operating in India, now you do not have to prepare many books of account and do a lot of compliances in India. For determining the taxable profit, you can presume that whatever income you have earned, 20% of the total receipt is your taxable profit, and then you pay 35% of that 20% taxable profit, and then that's the end of story. You do not need to go into a lot of books and proving a lot of documentation to the Indian tax authority. So that would make life of the taxpayer, if you are into cruise ship business, very easy. For liaison office, there's some small penalty which has been introduced. So there was a timeline of 60 days to file certain statement, but there was no penalty. Now government has introduced a penalty of 1,000 per day to the maximum of 100,000 INR. A few changes in the tax litigation. I'm not covering in each and every item in the interest of time, but the only major point which as a non-resident I would be concerned is this reopening of cases. So India has this law wherein tax officer can reopen the past cases. Earlier, the existing timeline to reopen the case was that if my income, which as per tax authority has escaped assessment, was less than INR 5 million, my case could have the tax office could open past 3-year cases. But if they say that my income escaping assessment was more than INR 5 million, they can go back to 10 years. So this created a lot of challenge also, because if I'm trying to acquire any company and I have to do due diligence, I have to do tax clauses for that. Usually I'll do the due diligence for 5-6 years maximum, and even the company would keep the records for 5-6-7 years as per different applicable laws in India. And also 10 years sounds very problematic, because I am always under the impression that, okay, tax office can go back for 10 years and reopen my case, and becomes very challenging and very disturbing for any investor. So government has seen this, realized that this is a problem area, and now reduce uh, the threshold for reopen. Now tax office can go back only to 5 years from the end of relevant assessment. So this is a welcome move, which would reduce the tax litigation and would also improve the sentiments as far as tax administration in India is concerned. Further, to add on to reducing the tax litigation, government is coming up with an amnesty scheme, a dispute settlement scheme, wherein they have provided different parameters. But the idea is that if you have any open tax litigation with the Indian Tax Office, you can analyze this scheme, which is yet to be notified. So just for an example, in the first row, you will see that if you have a tax demand, plus there is an interest, also there's a penalty leviable on that particular demand. Now, what you can do is you can pay the 100% tax disputed demand, and the interest and penalty would automatically be foregone by the tax department. And then you can buy peace of mind in terms of litigation is concerned. Having said that, one could say that I already have on this particular issue in past year received some favorable order from the higher authority. So in that case, government is saying that in those cases, you can pay 50% of tax amount, and then we'll settle all the disputes. So that's something which we need to analyze whether it's beneficial for us or not, what kind of litigation cost we are looking on, how much time this would be dragged on. And with this cost benefit analysis, we can really go and see what are the open tax litigation, and if possible, we can make use of this dispute settlement scheme. So this was it from my side from direct tax perspective. Now I would invite my colleague Khushbu, who can take up the custom matters.
Hi everyone, Maya, is my screen visible?
Visible, yes. Just put it into presentation mode. Perfect.
Yes.
Thank you.
Yeah. Hi everyone, Khushbu this side, and I'll be taking you through the customs proposals. So first of all, I wish to highlight that the proposals for customs duties have been intended to increase the export, deepen the value addition, domestic value addition, and to ease down the tax rates. So the first custom proposal that has been proposed in this budget is removal of certificate of origin for the purpose of preferential duty. So earlier, the importer used to provide a certificate of origin at the time of import to prove the originating country. Now this has been changed from certificate of origin to proof of origin. This change has been made to align new trade agreements which are being entered by India, and different type of proofs have been used for certifying the origin. So this would be applicable from the date of enactment of the finance bill. The next change which has proposed in the Customs Act is non-applicability of a mover scheme for certain type of manufacturing activities or activities for certain kind of goods. So there is a change in section 65. Next is the compensation sets, which has been removed for imports by the SEZs. And this change has been done from retrospective effect. That means SEZs are not required to pay compensation cess with effect from July 1st, 2017. The next change is the change in Section 6, which empowers the government to impose protective duties on indigenous industries. This section has been omitted, and now there will be no imposition of protective duties going ahead. These were the changes in the Act, and these will be applicable from the enactment of Finance Bill. I would be taking the next changes which are happened in custom tariff. So few of the entries which has added in the custom tariff are listed in the right, which includes paracetamol, e-bicycles and battery operated pedals, lorries and trucks, machineries to be used in chapter 88, which are defense. So these are being inserted to rest down the various classification issues which are happening revolving around these particular products. These changes will be applicable from 1st of October 2024. Few of the rates have been increased on certain products to help in Make in India, and these are plastic products, chemicals, and PCBAs and solar glasses. This is to increase the domestic manufacturers, help the domestic manufacturers. Similarly, BCD rates have been decreased for certain products, which includes gold, silver, platinum, medical equipments, mobile chargers, and PCBAs. So these changes will be applicable from 24th of July 2024. Rest time limit has been prescribed for certain exemptions. These time limits have been, the sunset clause has been increased from 31st March 2024 to 2026. These are machinery, components for setting up fuel cell based, work of art, goods imported for execution. This is just to promote such kind of industries in India and to increase the relevant exports. Few of the exemptions have been increased from 31st of March 2024 to 31st of March 2029, which includes import of capital goods, machinery used for IT, electronic industries, specified raw materials and inputs used for electronic manufacturing of electronic items, articles for foreign origin and imported for repairs. So these were the few changes which has been introduced by the customs under the custom tariff, and rest, this is from my side. Over to you, Sudipta, for the GST amendments. Thank you.
Thanks. Thanks, Khushbu. If I may, I'll just share my screen. Just a second. Is my screen visible?
Mm-hmm.
Okay, let me just put it on presentation mode.
Perfect.
Yeah. Okay.
Thank you.
Okay. Good afternoon, everyone. So I'll quickly take you through the key GST changes in this budget. A lot of these have flown from GST Council meeting recommendations that happened about a month or so prior to the budget. The key theme that sort of comes up from the finance minister's speech is a massive rationalization of GST rate structure. Now we need to understand that in GST today we have 4 broad rate structures. Of course, there are other smaller rate slabs, but primarily it's 5%, 12%, 18%, and 28%. There has been a lot of discussion about merging the 12 and 18%, or coming up with a more sort of a revenue neutral mid-tier rate. But there has been no consensus. But now a group of ministers has been reconstituted, and there is hope that within 5 to 6 months we might have a fairly large rate rationalization exercise. What needs to be really emphasized at this stage is every time there is a rate rationalization, the question of anti-profiteering provisions under GST law would also trigger. Anti-profiteering law, for those of you who may not be aware, under GST, what it triggers is if there is a rate reduction, there has to be a reduction in the cost that a particular entity charges to its customers, commensurate to the rate reduction or commensurate to the benefit of the tax reduction or enhanced credit that it may receive. The last time there was a large-scale rate rationalization, there was a massive spurt in anti-profiteering litigation. There are a lot of learnings that one can take from that, especially companies in the direct-to-consumer space, in the FMCG space, basically any consumer-focused sector. Would need to be cognizant of the learnings that have emerged in the last 3 years from the anti-profiteering litigations. On anti-profiteering, one important change that has happened in this budget is that section 171(2) has been proposed to be amended, which will give the power to the government to notify a sunset date beyond which anti-profiteering cases will not be accepted. Currently, the date is expected to be 1st April 25, but my sense is if there is a rationalization of GST rates by November, December, or maybe January, this date could be extended to give full play or full protection of anti-profiteering measures to customers after that rate rationalization. Another thing that has happened is currently the anti-profiteering complaints, the tribunal that hears it is the competition authority, and from September or October onwards, all of those cases will move to the GST appellate tribunal, which is now in the process of being set up. The next important change is in the alcoholic beverages space. Now, some of you may know that India, being a federal country, federal structure, federal constitutional polity, alcohol, like many other items, were in the sole prerogative of the state governments, the provincial governments, to tax. Alcohol for human consumption was very clearly within the state's jurisdiction to tax, but the questions often arose vis-a-vis raw materials like extra neutral alcohol or rectified spirit, which are clearly not alcoholic liquor fit for human consumption, but they were, to the extent they were being used for alcoholic beverages, whether they could be taxed by the state or whether GST could be levied on that. And there was a fair amount of litigation on that. In this budget, what has been proposed is to specifically exclude extra neutral alcohol or rectified spirit, which is used for manufacturing of alcoholic beverages, from the levy of GST. Now, bear in mind that this is surprisingly a prospective amendment, which means this will be applicable from the date it is notified to be applicable. So one needs to see what happens to the past matters that have already arisen, that are at various stages of high courts or tribunals or at assessment levels. What happens to those cases in light of this amendment, I think, remains to be seen. But the idea clearly is to set to rest this particular controversy and lay down clear boundaries as to who will tax whether it's the center, whether it's the state, and which part of it will be liable to GST and which part of it will go to the state. That boundary is sought to be drawn. The next one is a important one in terms of tax litigation reduction process or objective. A new section 11A and corresponding provisions in various other statutes is sought to be added. This will enable the government to issue notifications to regularize, past tax practices. So if a particular sector has taken a particular tax position, whether to pay at a lower rate, whether to take an exemption, and the government disagrees and there has been ongoing litigation, the government may decide that, what, because this was an industry position, this was an industry issue, we will just regularize for the past and say that, okay, you get it right from a particular cutoff date. One sector that could immediately be a beneficiary of this is the online gaming sector. Some of you would be aware that massive GST litigations are being fought for the past period by online gaming companies in India. One hopes that this would be one of the sector that government utilizes this particular section whenever it comes into effect. One thing to remember is that there is no refund available. So even if exemption is issued for the past period under this newly introduced section, the companies who would have paid tax, they will not get any refund because of that exemption. But apart from that, I think this will be a very important enabling provision and a very useful tool for any sort of public policy advocacy by industry associations. These are credit-related changes. These are also beneficial in the sense that there has been a lot of litigation as to the time limit for these financial years, 2017-18 to 2020-21. I'll not go into the details. This is rather procedural, but suffice to say that I think this will help a lot of SSEs who would be fighting litigation vis-a-vis credit availment for these financial years. The next one that I want to spend a little time on are the summons related provisions under GST. There was no specific enabling provision under GST wherein a person or a SSE who has been summoned could send an authorized representative on his or her behalf. That enabling provision is sought to be introduced in this section, new section 71A. But this representation through an authorized representative will be subject to the summoning officer's discretion. Important to bear in mind that the representative will obviously be bound under oath to state the truth and to produce relevant documents. So whoever this person is representing, the principal, will be bound by the representative's recorded statement unless retracted. So one needs to be very cautious while using this particular option that the representative will answer, will maintain the narrative that is sought to be built, will state the truth as it is sought to be told, and otherwise be very careful about retracting that statement at the earliest possible opportunity. In the specific context of a lawyer being given the authority to represent a client, it will be interesting to see how attorney-client privilege will work in this particular context, because for a lawyer, generally, if he or she is summoned, one could plead the attorney-client privilege and refuse to answer. But if a lawyer is specifically appointed by a client to represent him or her before a summoning authority, whether attorney-client privilege still extends, I think will be something that we will see some amount of litigation on as we go forward. This probably is the most radical amendment that is proposed in this year's budget. You see, in tax law, as you'd be aware, there is always a look back period. It could be 7 years. It used to be. Gaurav touched upon the reduction of that in his session. For indirect taxes, even prior to GST, there was always a distinction in the look back period or the limitation period depending on the severity of the allegation. So if the allegation of tax evasion was based on fraud or suppression or those sort of things with a clear intention to evade tax, the limitation period would be higher. But if it was for a bona fide mistake where serious allegations of fraud or intention to evade was not been invoked, it was always a lesser amount of look back period. In GST, typically the look back period was 5 years in cases of fraud, suppression, etc., and 3 years in other cases, in the more bona fide sort of cases. What is being proposed is, in a departure from all existing norms or all historical precedents of indirect tax laws in India, that we will have one common look back period of 42 months. What that means is, for all section 74 cases, 74 is the section which pertains to fraud suppression scenarios, there will be a reduction of 18 months from the limitation period. And for other cases, for the more bona fide cases, there would be an increase of 6 months from the in the limitation period. Now, one might say that on the face of it, it seems a little unfair that where the allegations were more serious, their limitation period or look back period is getting shaved off. When I posed this question to the government authorities who were behind this particular provision, their logic was that a lot of the notices that get issued by the government, by GST authorities across multiple states, are without really applying their mind in a very objective manner. They just invoke section 74. They allege fraud, suppression, etc., without really examining the facts very clearly, because that gives them a longer time to pursue a particular tax dispute. So their point was that we are being practical. We are reducing the look back period so that litigation reduces, so that one can close their files for a particular assessment year relatively quicker. In this provision, once it comes into effect from the next financial year 24-25 onwards, show cause notices would have to be adjudicated within 12 months or extendable by another 6 months. While the limitation period will be the same for 42 months, there could be differential penalty. There would be higher penalty if the cases, if the allegations of fraud, willful misstatement, suppression of facts, some of these allegations are proved, then the differentiation will be made in terms of the penalty and not in terms of the limitation period. There has also been a consequent amendment in section 17.5. 17.5 basically deals with scenarios where input credit of GST will are restricted from usage. You can't use input tax credit to pay off the output GST liability. Now, one specific scenario under 17.5 was when tax was paid under section 74 in cases of allegations of fraud, suppression, etc. If it was passed on, the recipient could not have utilized credit of that. So that section is sought to be deleted with effect from the next financial year, which I think should be a helpful thing going forward. Now, of course, the fairness of this, like I said, one could argue that for more serious allegations, more severe cases of tax evasion, the limitation period is being shaved off. We might see some litigation, some pleas for judicial review vis-a-vis that particular aspect. But the intent, as I just mentioned, is to reduce litigation going forward in the long term. These are also important beneficial provisions that have come in. Some of you may be aware, under GST, if you need to file an appeal, the first appeal you have to pre-deposit a fixed percentage of the GST demand, and for the second appeal, again there is another pre-deposit that is required. So earlier it was 10% plus 20%. Now it is proposed to be reduced to 10% plus 10%, and the overall cap for pre-deposit is also being reduced. While I genuinely believe this is still quite high, but at least we are moving in the positive direction. We have reduced it to a total of 40 crores at the second tier. I'm hoping that as we move forward, as GST stabilizes more and more, the pre-deposit amounts would also come down. But here, one point that is worth highlighting, and this is something we have represented to the government also for reconsideration. There was a circular issued right before the budget came out, which basically said that till the time, some of you may be aware that the GST appellate tribunal is not yet in place in India. It is expected to come in force from September of this year. So in the meantime, people who have lost their first appeal, some of the SSEs, some of the taxpayers have been facing recovery pressures from their jurisdictional GST authorities, and they had represented to the government that there should be no recovery because it is not my fault that I can't file the second appeal. The GST tribunal is not in place. Why this circular of 224 of 24, what it specifies is you have to declare your intent to file appeal along with the pre-deposit amount as prescribed on the table on the slide before you, in order to be protected from recovery. Now, one can understand that there has to be a declaration of intent to file appeal. That's fair enough. But the part where it talks about a pre-deposit, making of the pre-deposit, even when the appeal is to be filed at a future date, the tribunal is not yet formed, that seems a little burdensome. And I'm hoping that this particular aspect would be reconsidered. Schedule 3 of the CGST Act basically prescribes certain types of supplies to be outside GST. They clarify that these are neither supply of goods nor supply of services. This particular clarification or amendment pertains to co-insurance space. There was a lot of representations that were filed by the insurance sector vis-a-vis apportionment of co-insurance premium by the lead insurer to the co-insurer, and it has now been clarified, thankfully, that both the apportionment of co-insurance premium as well as services by insurer to the reinsurer for which a ceding commission is paid shall not be treated as supply of goods or services, and to that extent will be outside GST. So I think this is of course a favorable outcome for the insurance sector, and this is again pursuant to GST Council recommendation. Gaurav mentioned amnesty from the income tax side. There has been I would call it a mini amnesty from GST side as well. A new section 128A has been proposed. Under this, for the financial years 17-18 to 19-20, if SSEs have received notices under 73, section 73, remember, pertain to the more bona fide cases of tax non-payment or short payment, where there are no allegations of fraud, suppression, etc. In those cases, for these specified financial years, if the taxpayer pays the tax amount there could be a waiver from interest and penalty. So many taxpayers for who are sitting on notices for under section 73 for those initial 3 years of GST may choose to opt for this and get rid of pay off the tax amount and get rid of the interest and penalty and close that particular litigation. In order to avail this amnesty, so-called, one would have to pay the entire tax by 31st March 2025. And the proceedings will be deemed to be concluded. The section goes on to prescribe the scenarios where this particular amnesty would be applicable. Where show-cause notice is issued under 73, but there is no adjudication order, where it is pending in first appeal, where it is pending for GST appellate tribunal, which is basically second appeal, where there is a section 74 SCN, but which gets reclassified into 73 in appeal. So all of those cases will be covered. There is no specific coverage for scenarios where matters are pending before High Court, on similar grounds. But what I have been orally confirmed when I spoke to senior tax officers in this regard is they will issue a circular which will clarify that even cases which are pending in a writ petition before various high courts, that should also get covered in section 128A. So we'll see once that circular comes out. But as of now, clearly, the intent is in the right place to reduce litigation, especially in the more benign cases, especially in scenarios where serious allegations of fraud, suppression, etc., have not been raised. So I think, and one important point to remember is this covers only scenarios of tax short payment. So cases or litigations pertaining to erroneous refunds, that is not covered in this mini amnesty. But despite the limitations and restrictions, overall, the heart is in the right place when one sees this particular proposed amendment, and one hopes that it will be implemented smoothly. I think that is all from my side. I'll invite my colleague Moin to take you through the regulatory challenges.
Thank you so much, Sudipta, for these really interesting insights.
Hi everyone.
Hi, Moin. You're audible and visible. Perfect. Perfect.
Hi, am I audible now?
Yes, you are.
Okay, lovely. So I think just trying to move my slide just one second. So what I intend to cover is generally the overview of the regulatory changes in the current budget. Key changes are there is a possible liberalization in the exchange control laws. As we all know, India is an exchange controlled economy, and our currency is not fully convertible. So there are various conditions and restrictions applicable to investments which amount to a capital account transaction in India. So that is the first topic we will cover. The second thing is there's a new avenue of investment that's going to be available, which is through variable capital companies. I know we're talking to you all as investors into India or having businesses in India. So this could be an avenue for treasury operations. We'll also touch upon changes that are going to be impacting trading on the stock exchange in the future and options segment. So the government's been discouraging that option for retail investors in particular, and have proposed some changes. And lastly, we'll speak of how the entire regulatory space is being digitized and how there is likelihood of better and more efficient corporate and banking sector. From an exchange control perspective, there are two aspects that are likely to be two changes that are likely to be undertaken. One is in the overseas investment regime. So when Indian investors are investing abroad, they are subject to the overseas investment regime. And it appears that Indian government would like to promote options and measures such that Indian gift city, which is the new free zone or financial free zone that government has set up in Ahmedabad, would be used for setting up structures and making investments under this regime. From a and there are clarifications expected around how that will be implemented and how rupee will be more and more usable and convertible for transactions. There is also a sort of proposal of having a special rupee Vostro account and a local currency settlement structure with bilateral swap arrangements. So India already has such arrangements with Japan, with Indonesia, and the UAE, and intends to expand the usability of Indian currency for various current and capital account transactions, not linked and not specifically with the budget, but this was just notified the day before, and it just shows how the government's interested and keen to sort of facilitate use of Indian currency for different transactions involving foreign investors or foreign parties. From a foreign direct investment perspective, we are expecting 3 key changes. One is that, as we all know, in 2020, there was a restriction that the government had laid out for investors from the bordering nations, particularly in China. So this would be relevant if you're looking at any co-invest models or any Indian entities which does have investors from bordering nations. There's very little clarity on what is the beneficial ownership threshold for such investors. There's a special approval prescribed without this threshold. So there's a likelihood that there'll be a clearer limit prescription and also a faster approval process. Now, as investors from your region, this does not impact you, but it does impact you when you are investing or co-investing. And it also is important to check if there are entities with foreign direct investments existing or about to receive foreign direct investment from bordering nations in India. The second liberalization we expect is for foreign owned and controlled company. And what I mean by that is, suppose you invest through a company in India. So you have an operating company already where you have undertaken foreign direct investment in India, and such entity is now going to further expand or further diversify into another area of business or acquire a related business. You are treated as doing an indirect foreign direct investment. And in such situations, there has been lack of clarity on if you can have a deferred investment structure or no deferred investment structure. That's likely to be clarified, because for all other reasons, except for notional calculation of the foreign direct investment, and FOCC is an Indian company. So just to give an example, a company from Germany has an Indian subsidiary, wholly owned subsidiary, or an Indian subsidiary. Such entity, when it invests into other Indian companies, these rules become relevant because it's considered as an indirect form of foreign direct investment, and it's considered as a form of downstream investments. In these structures, there have been a lot of deferred structures in the past where you can defer as much consideration you like, but there has been concerns in the recent past, and we expect clarifications to come through. You also, the other change that's going to be relevant is, today we have a 18-month and 25% indemnity holdback limit. So if you're investing in an Indian entity and you can have, for any sort of possible losses or for any sort of earn-out structures where you set up some targets of either repaying loans or reaching a certain revenue threshold, you can have a deferment or an indemnity escrow of up to 25%. And this, I'm talking about direct FDI, and the period is 18 months. There is an expectation or hope that as part of easing FDI, this would be sort of further, sort of increased to a longer period, because we've seen, or it will become more sort of generic, where periods would be defined basis the amount, basis the sector, or basis various other conditions that will get prescribed. Now, this is really a new model of investment, which is otherwise possible and popular in the Singapore and Delaware region, where you can invest into India probably through a new model of which is a variable company, capital company model. Here you have to very simply lay out, it means there'll be one company where there will be different cells. And if you're intending to just make a financial investment, this may work beautifully because you don't need to have the hassle of maintaining a company, undertaking appointment of directors, employees, doing the whole payroll. Instead, you just invest in a structure which has multiple investors, but you have a protected ring-fenced cell through which your investment is being done, and you are therefore protected from the impact of other cells. Now, that being said, this proposal has been discussed, but it's very unclear at the moment whether this would really be available to all investors, whether this would only be available through the Gift City. If it is only available through Gift City, then this would more so become a treasury operation opportunity for companies that are already existent in this region and who want to sort of diversify and make further investments. As I mentioned in the beginning, the government has been very closely looking at the future and options segment of the Indian stock market, where and it has been noted clearly that there have been a lot of losses incurred by investors. It seems that 89% of traders in this segment are incurring losses, particularly retail, investors, and hence what has been decided that there are certain sort of measures being proposed which would sort of increase the amount of investment, and in line with that, the securities transaction tax has been marginally increased to sort of in a way dissuade retail investors, but there are also certain stocks in the Indian stock market which are really heavily dependent on such trades, and they don't really trade in the delivery based segment. So one needs to see how the government will eventually balance it and whether they would probably go to a place where it will only be limited to accredited investors. And this really update would only be relevant for entities which are already listed and have an F&O trader. There is a possible likelihood of this getting reduced. The Indian government has taken various steps and across regulators to digitize and create a sort of system which is very efficient but also very data driven. We know that the Reserve Bank of India has now created the Prava portal for all your approvals that you need or any reportings that you want to undertake. You can now do so via the Prava portal. There are about 60 matters for which approvals can now be sought through these portals. You will be able to receive your questions, check your status, and provide your responses, all of those on the portal. If you're not within those 60, you'll still go back with the plain paper as you've always done. We also know that all the reportings for inbound investments, FDI into India are all digitized now. You're able to check the compliance statuses. It has eased due diligence really. That being said, the issue really is that all of this is coming at a cost where there is better surveillance, better cooperation amongst the regulators, better data sharing between the tax department, tax authority, the securities regulator, and the foreign exchange regulator. And as Gaurav mentioned in the beginning, that if there is a question on source of funds, it's very easy for the tax department to alert even the exchange control regulator, and there could be a lot of concern if there are any issues around that or if the data is not available to us. And I mean, the last bit that I wanted to really highlight was the fact that Indian companies, it's very, very easy to set up companies in India, but it's extremely difficult to close the companies or to wind down those companies. And what has been proposed in the budget is that if you enter India through a limited liability partnership model, which is one of the entry routes, and this is only workable in sectors which are without any conditions, so say a manufacturing sector or any automatic route sector, then you have a shorter and a quicker voluntary closure mechanism. Otherwise, closing India, so shutting down and liquidating Indian companies can take more than a year. The government's also focused and acknowledged the fact that there are a lot of pressures on debt recovery tribunal, national company law tribunal, and therefore the number of such tribunals, it is expected to set up more of these, and also implement a tech platform to speed up recoveries under the Insolvency and the Bankruptcy Code of 2016. So I think all in all, the measures of government seem to be focused in easing business, providing tech support, having benefit of the available data, and at the end of the day, having a zero tolerance for non-compliance, and therefore having a very good surveillance mechanism really in place. So I think that's something that I wanted to highlight. It's a short update and limited update from a regulatory perspective, but I think very happy to take any questions or any queries that you have in this regard. Thank you, everyone.
Thank you so much, MIIM. And that's also a good transition to our quick Q&A round. Do feel free to keep posting questions. I will take up 1 or 2, maybe 3 questions, depending on the time and the interest. And I would just ask all my fellow speakers to switch on their cameras, if possible. Thank you so much. Great. Okay. So, of course, we have heard a lot about the budget now and all the relevant changes and all of that. What I would like to do now is maybe ask 1 or 2 questions which are a little more regarding opinion, let's say your personal opinions on a couple of changes. So one question I would like to ask here is, and I think that one might probably be going to Gaurav most likely, how do you see the tax litigation scenario in India in the next days? And are there any specific points, from your opinion, that German companies should be aware of when investing in India against this background?
Gaurav, you're on mute, I think.
Thanks for the question. So as far as can you hear me now?
Yes, perfect.
Yeah, okay. So great. So thanks for the question, Maya. I think that's a very interesting question. And as we see the changes in the budget, and also over the past 5 to 8 years, if you see the kind of reforms which government is bringing in the tax laws, be it direct tax law, be it indirect tax law, the tax litigation is one area which government has seen primarily. There was a time in 2012 where there were a lot of changes made in the Indian Income Tax Act from retrospective effect. And thereafter, the sentiments of the investor were not that great. So this new government, which came up in 2014, had decided first that they'll not bring in any retrospective amendment. So that's a starting point which government started to build in this trust factor. And the main part where they have worked is to reduce the tax litigation. Already we have seen that this is a settlement scheme which we discussed in our budget. This is 2.0. There was similar budget scheme, amnesty scheme, which was brought in 2020, 2021. So those kind of things government is already coming up to reduce or settle the tax litigation. There is an advanced pricing agreement, there are mutual agreement procedures which are happening on the sideline to reduce the transfer pricing cases. And also if we see the tax rates, etc., has been streamlined or reduced, and all the tax incentive, which were the major reasons for all the litigation which were happening as far as tax is concerned, is something which has been removed from the tax law to make the effective tax rate a little lower, but reduce or take away all the incentive which have a lot of conditions or gray area. So the idea is to make in future law which is more easy, simple, less complex, less gray areas are there. Of course, if you create any law, there are tax law, there would be some confusion, there would be different ways of approaching or looking at or interpreting things. So things would be there in the future as well. But as far as government approach is concerned, they're trying to reduce the tax litigation as much as possible. So we see a positive trend already, and we expect that this would continue. For German perspective, I would say that the things which were in past 5 years, it has improved a lot. We have now online tax assessment proceeding where we see a very positive change. Now we do not have to, or tax officer cannot approach us directly. They have to route it through an online platform only. So a lot of transparency and accountability has been increased. So even from German perspective, European perspective, that is something which is a positive note. And things like removal of equalization levy of 2%, which we talked about, is something which was a demand of German industry also, to remove that, to bring clarity. A reduction of corporate tax from 40% to 35% is something which German banking insurance industry were trying to negotiate or discuss with the Indian government. So this is something which has been introduced. So all those points, government is listening to the industry, reducing the tax litigation. So overall, a very, very positive environment, I would say.
Perfect. Thank you so much for sharing your honest opinion on this. I would like to take up one more question, because Sudipta, you talked a lot about this new section 74A. Now, may I ask you, how do you, again, in your personal opinion, perceive the new section 74A, which provides a common look-back or limitation period for GST cases, irrespective of whether there's any allegation of fraud, suppression, etc., or not?
I mean, I briefly touched upon it. It seems on the face of it a little unfair, so someone who is facing a very serious charge of fraud, suppression, etc., they're getting a large chunk of the limitation period shaved off. So basically their look back period becomes much smaller compared to someone who has a rather more benign sort of a allegation against them. In law, I mean, and this is not specific to tax law, in general law under India, we have, I mean, and everywhere under constitutional laws, we have the concept of equality. And one of the facets of equality is that don't treat unequals equally, right? So the question is, someone who has an allegation of fraud, suppression, etc., versus, someone who does not, can you treat them at par? Can you have the same look back period? I get the practical perspective from where the government is coming from, that since there is so much litigation around whether there is a fraud suppression case, we don't want to get into that debate. But I think that it's a too overbroad sort of solution, and to my mind, if challenged in a court, in a constitutional court, it may not withstand scrutiny. On the face of it, it seems a little unfair to me, to people who have bothered to be compliant and pay taxes on time and done all the right things, to have their limitation period increased by 6 months in the interest of uniformity. Yeah.
Okay, thank you so much. So in that case, I think regarding or concerning the time, I think I would slowly come to my closing words, unless someone wants to ask another urgent question, which I think is not happening at the moment. So thank you everyone for joining this webinar today. And we hope you found it informative and engaging. And we understand, of course, that your time is valuable, and we really appreciate that you chose to spend it with us here. If you have any further questions or comments, please don't hesitate to reach out either, of course, to the MIIM program or to our speakers here. And we would be happy to continue the conversation and provide any additional information you may need regarding, of course, the union budget, as well as other topics that might be of concern to you. Last but not least, I would like to once more thank our speakers here, Khushbu, Sudipta, Moin, and Gaurav, as well as, of course, the Embassy of India, Khaitan & Co., and Rödl & Partner for the support. Thank you, dear attendees, for your patient listening, and we look forward to connecting with you soon. Until then, stay safe, stay healthy, goodbye, und auf Wiedersehen. Thank you so much, everyone. Thanks.
Thank you.
Bye.